Unilever is one of the largest and most successful consumer goods companies in the world. As a global company, they strive for sustainable growth and providing their customers with a wide variety of products, such as foods, drinks, personal care, and home care goods. This company was once co-headquartered in Rotterdam, Netherlands, and London, United Kingdom, but have recently decided to move out of London and base their headquarters in just the Netherlands. Unilever is one of the oldest multinational companies which offers products in approximately 190 countries. They are the world's largest producer of food spread, such as margarine. And to put it into perspective how dominant Unilever really is, over the past year, consumers used Unilever products 2 billion times on a daily basis. Everyone in this room has Unilever products in their homes, but just don't know it. The purpose or the goal of this video is to present a detailed overview and analysis of the financial status of Unilever of the past few years. This will include its projections for the future as well as providing the detailed analysis of the foreign exchange risk that will satisfy any potential investors in the company. We are also going to analyze Unilever's return on equity performance, analyst recommendations, analyze their holdings, and understand the percentages of the company in foreign and domestic markets. Unilever's history is rich in detail and fairly lengthy, but through the years it has consistently produced steady growth, dominating the market. Even though Unilever has been so dominant, that doesn't mean there aren't competitors out there, so we will take a look at that as well. In addition, we are going to fully understand the challenges Unilever faces, which is more frequent in the past few years as they acquire more aspects to their business. But to fully understand the way Unilever carries over most goods that are used by the majority of people around the world, we must first understand the history of Unilever in order to appreciate the current status of this global empire. The beginning point took place in the late 19th century. The Industrial Revolution was in full effect, and Britain was quickly replacing its farmland with factory development. This caused an astronomical growth in population and an even bigger disparity between the rich and the poor. This created a shortage of butter. Now you probably are thinking that this isn't that big of a deal, but in fact it was. During this time in history, butter was a vital ingredient in maintaining the health of the population. Arising from this shortage, a huge competition between two family businesses who were heading the innovation of butter came about. The rivalry between these two Dutch families brought innovation, increasing shelf life, improving flavor, and implementing vitamins to butter. Eventually, these businesses merged and called themselves Margarine Uni. At the time this was taking place, a man named William Lieber was building another business. Within this business, he changed the way soap was produced, bought, and even used for that matter. Back in the day, soap was sold to markets in large blocks, but he introduced the world to a small packaged bar of soap. The idea created a brand that was ready for consumers to use. This revolutionized merchandising all over the world, appealing to the individual needs of each and every person. Then, in 1920, these two companies combined their resources and names to create one logo for a small price margarine consumer-based brand, an effort to dominate the market and provide for those who need products of necessity. In the 1960s, they developed margarine to help maintain healthy cholesterol levels when worries about heart disease became a major concern. In the 1990s, Unilever tackled the fish and agriculture market, implementing sustainable initiatives to maintain the fish population and protect and ensure energy-efficient, clean farmland. In 2004, Unilever's ice cream businesses, for example Ben & Jerry's, worked with Greenpeace to develop ice cream freezers using natural refrigerants. In 2007, Unilever began to sustainably source all of the leaves that go into their Lipton tea drink and tea bags. And finally, in 2008, they got involved in the laundry detergent market in Europe, developing a product allowing clothes to be washed at a lower temperature. As history has shown us, Unilever focuses on growth and sustainability no matter what market they break into. Since Unilever is basically everywhere with its hands in so many markets representing so many brands, there are very few competitors that can make a significant impact on their market, but there are standout companies that do compete with the industrial powerhouse. These companies include Procter & Gamble, Avon Products, and Revlon as their biggest competitors in today's market. The personal care industry is one of Unilever's best and fastest growing branches of business. Their most popular brand, Dove, is one of the largest name brand consumer health products on the market. And while Revlon and Avon Products are not large holding companies like Unilever, they are strong competitors in the beauty and healthcare industry. These two companies do not pose any significant threat to the beauty brands Unilever holds, but they all contribute to its competitive market field. The main competitor of Unilever is without a doubt Procter & Gamble. As we see very often, competitors tend to be very similar, and that is evident here when it comes to P&G and Unilever. Each company runs a global consumer goods business that is in control of dozens of top name brands, which are used by billions of consumers every day. These two stocks post similar profit margins and dividend yields, yet the two businesses represent very different investments. Differences are found in each company's growth profile, brand strategy, and capital return policy. In looking more directly at each company's strategy, Unilever's growth came mostly from pushing volume and pricing gains, while P&G has to rely solely on higher prices and elevated advertising. P&G's top brands include some of the following household names shown above, such as Tide, Bounty, Charmin Ultra Soft, Gillette, and Crest. It reports its earnings in 5 segments: beauty, grooming, healthcare, fabric and home care, and baby, feminine, and family care products. Now for Unilever, they sell top brands such as Dove, Axe, Rexona, Lipton, and Ben & Jerry's. It reports its earnings in 4 segments: personal care, home care, foods, and refreshments. Revenue at all 4 units rose on an underlying basis last quarter, and over the last 5 years, its underlying sales growth has had an average of 3.6%. The business year of 2017 was one of increasing progress for Unilever as it once again outperformed the market prediction. Unilever has generated free cash flow of $22 billion over the last 5 years and has shown good quality line growth. This company has been a steady earner for investors. Unilever is a steady growth company, but as we can see in the turnover growth charts, the past 2 years have been significantly less in 2015. This may be attributed to the introduction of Brexit in the UK, which has led to a large decrease in the pound's value, which has then led Unilever to raise prices despite a highly promotional and challenging environment the UK possesses. In fact, the latest news has stated that big changes are coming for Unilever. They have decided to base its headquarters in the Netherlands, leaving London and Brexit in the rearview mirror. Along with Brexit, the catalyst for Unilever's restructuring was the $143 billion takeover bid the company received from Kraft Heinz a year ago. Unilever managed to fight off the bid, but felt compelled afterwards to make changes to satisfy investors. Analysts say shareholders will welcome the simpler, less bid-proof structure, and the change will make it easier for Unilever to make big acquisitions or spin out businesses. In addition to value line, I sought out for more analyst reports from Reuters and Morningstar. They all have similar views and recommendations regarding the future of Unilever. Unilever is regarded as a safe haven ADR that is consistent and provides steady growth. In 2016, Unilever had parted ways with much of its margarine, doing so in hopes to focus more on innovative industries, hoping to generate an increased dividend value, thus generating more share appeal and long-term price value. Unilever shows extremely high in price stability. Over the past few years, they acquired a company called Living Proof Incorporated. This company possesses high upside potential and innovation in the cosmetics industry. They also sold off low-earning businesses. For example, they sold Aid S, a beverage company, to Coca-Cola Company for $575 million. They also bought Blue Air, the leading supplier in mobile indoor purification systems. All of this was set up for the next 5 years to generate high returns and an accelerated delivery of value and benefits to shareholders. Despite the impact of Brexit these past few years, Unilever remained profitable, maintaining growth and sustaining their free cash flow from 2015 to 2016. In fact, their free cash flow grew by $600 million in 2017. I will say, though, as of right now, this may not be the best buy because of all the moves and changes Unilever is going through. Although, as a little bit of time passes and Unilever regains its strides, this stock has secure long-term potential and has shown this year in and year out. In my research, I came across a consensus chart from analyst recommendations and revisions on Reuters. The consensus recommendation was that Unilever has outperformed, even though a hold on this stock seems like the more sure thing at the moment. But if you want some encouragement to buy stock despite recent news surrounding Unilever, listen to Philip Gorham from Morningstar, as he recently said, in some of the most competitive categories, Unilever is facing its challenges head-on. To me, he sounds optimistic about the future of Unilever. Here we can take a more in-depth look in the details surrounding the Unilever stock. Unilever is currently priced at $53.31, up 0.53%. The chart shown represents the share trend over the last year, the 52-week high being $61.62, and in the 52-week low, it is $49.27. Yield-to-date change is down 5.34%, and market cap is about $157 billion. Shares outstanding is 1.7 billion, but more importantly, the estimated earnings PE ratio is 18.32, which indicates this is valued rather average based off the share price of the investors having a fair amount of faith given stock's steady earnings. The earnings per share over the past 5 years have steadily been increasing and now currently sits at 2.36, which are the highest it's ever been. Once again, this shows that Unilever is not in trouble despite a major change to their business, referring to them leaving London. Just as significantly, this screenshot image from Bloomberg shows the insider trading taking place in the company. 7 of the 9 are purchases. This is a good indicator of faith from within, especially after recent news and slightly uncertainty that surrounds the company. Here we can see P&G stock, which is very similar to Unilever's. Their current price is at $78.66, down 0.39%. Over the last year, the 52-week high at $94.67 and the 52-week low was $77.90. Yield-to-date change is down 14.39%. The market cap is at 198 billion and shares outstanding at 2.5 billion. The estimated PE is 18.71, which, like Unilever, is fairly average. P&G's earnings have been fairly consistent, floating around the same value the past 5 years, although slowly decreasing between 2013 and 2016. We can see this chart in the screen grab above that shows 49 transactions that took place in the past year, with the majority being on the sell side rather than the buy side. This amount of internal sale doesn't show any long-term confidence from within and shows uncertainty and lack of faith in the attitude of the company. In my opinion, if Brexit never came about, Unilever would be a better company on paper with fewer variables surrounding the near future. But now, after understanding that Unilever has left London and Brexit, and also taking into account how they've previously and continuously positioned themselves toward driving their share price and dividends up, I would put my faith in Unilever and buy stock. My reasoning behind this stems from the analyst recommendations, the company's insider trading trends, and their commitment to sustaining growth and maximizing shareholders' wealth. With all this company has withstood over the years, from revolutions to recessions to crises, it makes me believe they can overcome any challenges that come their way. Unilever continues to push towards the future through innovation, and that is the most promising thing about them. Thank you for listening.